The new year of 2026 opened in a fury for silver. What felt like an ordinary market day suddenly turned into a financial thriller. Silver spiked to a jaw-dropping $84 per ounce, shattering previous records, only to face frantic interventions by exchanges. Reports whispered of an even more incredible number overseas, $91.13 on the Shanghai Gold Exchange, creating an arbitrage gap that alarmed traders on two continents. Overnight, silver had become the star of a drama. Prices swung wildly, futures exchanges hiked margin requirements, and even tech billionaire Elon Musk chimed in, tweeting, "This is not good. This isn't just a market glitch, it's a signal flare in the night, hinting at deeper cracks in the global financial system." In January 2026, paper silver, the price on COMEX futures, was on fire. But physical silver, the metal in hand or in vaults, was burning even brighter. A wave of events, a Chinese silver export ban, trading frenzies in Asia, plus time-tested manipulation tactics, collided to push silver into uncharted territory. What does this sudden surge mean? Is it a genuine market phenomenon, or the endgame of a decade-long game of smoke and mirrors with precious metals? In this video, we go all the way deep, through history, economics, and conspiracy, to unpack the silver saga. We'll chart the record highs and roller coaster movements of recent weeks, revisit historic silver crises, from the 1980 Hunt Brothers saga to the 2011 silver bubble, and expose how the paper price of silver has been nudged far apart from its real physical price. Then we'll turn conspiracy detective. Could major banks and exchanges have been steering silver's price all along, and are they finally losing control? We'll cruise the geopolitical map, comparing Shanghai to New York, Beijing to Washington, and even New Delhi, to see how global politics play into this metal's madness. Expect drama, serious analysis, dark humor and metaphors, and plain English explanations for even the most complicated jargon. Strap in. This is a wild ride through the world of silver, and it's far from over. 1. The January 2026 Silver Storm. Silver's recent adventure began with a bang. In December 2025, the metal had already been on a tear, more than doubling in price during the year, but every trader felt that something extraordinary was stirring. Conversations on trading floors and internet forums were full of astonishment. December 29th, 2025. Silver's spot price on the futures market exploded past $80, briefly touching about $83.62 before profit-taking brought it back down. It was the first time ever that silver had broken the $80 barrier. The rush was fueled by a mix of things. Whispers of U.S. interest rate cuts in 2026, flight to safety buying on global tensions, and an unexpected export control from China. China announced that starting January 1st, 2026, only select licensed companies could ship silver abroad. A move akin to China's old rare earth policy. Traders loaded up on silver, believing shortages were coming. December 30th, 2025. Just as the year was ending, momentum traders and news broke all at once. Silver spiked even higher intraday, nearly $84 on COMEX, before a sudden plummet. In one day, futures fell by 9%, the sharpest one-day slide since early 2021. What happened? Chicago's CME group overseeing COMEX tripled margin requirements for silver futures within a single week, forcing leveraged speculators to either put up a lot more cash or get out. Overnight, an invisible hand, the exchange staff, had yanked the rug from under high-flying silver contracts. January 1st, 2026. On New Year's Day, with most Western traders asleep or offline, the new Chinese license rules took effect. Gold and silver were reclassified by Beijing as strategic resources needing special export permits. Only about 44 big companies qualified for these silver export licenses. China, by the way, accounts for 60 to 70% of the world's refined silver, so this was like turning off a faucet. The result? In Asia, dealers scrambled to secure any silver they could find. In nearby markets, Tokyo, Singapore, Dubai, etc., customers found physical silver priced at enormous premiums over the official quote. Some dealers in Japan and the UAE were listing physical silver at the equivalent of a $120 to $130 per ounce, even as Western exchanges still showed around $72 to $75. That's an 80% premium, something that had never happened before on that scale. Lines formed outside bullion shops in Shanghai, Hong Kong, and New Delhi, where any available bars or coins were snapped up immediately. In this very real way, Asia decoupled from the West. While COMEX traders parked on paper labels of $72, people physically buying silver were paying nearly double. January 7th, 2026. The frenzy continued. In Shanghai's morning benchmark fixes, silver cratered and exploded with parity. At one point early this week, the Shanghai Gold Exchange, SGE, silver fix, spiked to an equivalent of about 91.13 per ounce. This was unheard of. COMEX prices were in the low 80s, but China's domestic price shot into the 90s. This created an enormous arbitrage gap, say $8, $10 per ounce difference. Chinese buyers could theoretically buy COMEX silver and sell in Shanghai at a fat profit. In reality, with export licenses needed and supply strained, even that trade was complicated. Still, the gap told the story. Paper silver, the futures price, was wildly lower than the actual demand-driven price for metal. By mid-January, Western markets began to calm, but the damage was done. Silver had made its point. The old tricks of margin hikes and fear of bubbles talk could only go so far. The scene was set. A giant gap between paper and physical prices. Regulators and central banks scrambling, and the world asking, why did silver go crazy and what happens next? Cliffhanger. But even as traders counted their losses and gains, it was worth remembering that this storm had been brewing for decades. What historical forces brought silver to this boiling point? 2. Silver's long dance, booms, busts, and turning points. Silver has never been just a quiet backing metal. It has a storied history of sudden spikes and crashes that rocked the markets and even economies. To understand today's upheaval, we need to step back and look at the big turning points in silver's price saga. Here are the epic episodes that made silver a legend in financial lore. 1870s, 1890s, silver in monetary circuits. In the late 19th century, silver was an official money alongside gold. Massive silver mines in the US, Nevada's Comstock lode, sent floods of metal into circulation. Silver prices plunged from $1.30 to $0.59 by 1879 because of oversupply and changes in U.S. money laws. Sherman's Silver Purchase Act, later repealed. Countries like India and others that used silver coinage saw inflation when silver fell. The lesson: government policies and mine discoveries can crash a metal's price. 1979 to 1980, the Hunt brothers and the hunt for silver monopoly. Fast forward a century. 2 Texas oil barons, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. Starting in 1979, they quietly, and then loudly, bought millions of ounces of silver, claiming more than 50% of the world's deliverable supply. Silver's price went berserk, from about six an ounce in early 1979 to nearly $50 by January 1980, a 700% rise. There were scenes of sheer chaos. The Hunts physically tried to pick up silver in Europe, driving some continental exchanges to close. It was a speculative mania like no other. The world took notice when the U.S. Treasury and COMEX jumped in to stop it. On January 18, 1980, exchanges raised margin requirements almost overnight, Silver Rule 7, cutting off speculation fuel, and the Hunt brothers' corner collapsed. Silver crashed back down to the $10-15 range within months. The aftermath was a disaster. The Hunts went bankrupt, banks involved took losses, and commodity regulation tightened. For years after, silver was nicknamed Hunt Brothers Silver, a cautionary tale of runaway speculation, early 2000s, rally and bear markets. For much of the 1990s and early 2000s, silver traded in the single digits and low teens. Occasional upswings, 2006, 2008, a brief rally to $21, were tied to commodities booms driven by China's growth or financial crises, followed by crashes, like the 2008 financial panic when silver dropped back under $10. Outside of speculator circles, silver-esque moves then seemed tame. The Hunt frenzy had put to rest many thoughts of sudden spikes, or so it was thought. Silver rocketed from $8 in 2010 to a peak around $50 in April 2011. Market commentators called it a bubble, akin to gold's 2011 peak. Commodity traders began speculating that another corner might happen as physical demand, especially from India and Asia, was strong, and more investors were chasing silver. COMEX responded by hiking margins multiple times in 2011, pressing leveraged longs to exit. Again, the price collapsed. Silver fell back to the mid-20s within months. This 2011 flash mirrored in 1980 on a smaller scale. A frenzied rise, followed by forced reversals due to margin calls and liquidations. The 2010s, quiet grinding. For nearly a decade after 2011, silver meandered. It mostly moved between $13 and $30, reflecting incremental gains in industrial demand, solar panels, electronics, EVs, but also periodic profit-taking and pressure from rising bond yields or a strong dollar. It did not draw massive headlines, but the groundwork was being laid. Each successive low was higher than the last, gradually tightening the bull wave. 2020-2021. Pandemic spike and silver awakening. The COVID-19 outbreak in early 2020 triggered chaos. As stock markets crashed in March 2020, silver, along with gold, initially tanked in panic. But by summer 2020, it recovered and started a new climb. Silver ran from about $12 to a peak near $30 in early 2021, a 150% increase. This was partly due to industrial demand, tech and green energy, and partly a safe haven bid as central banks flooded the world with cash. Retail investors, familiar with Bitcoin mania, also jumped into silver. People remember memes about stacking silver like stocks or digital assets. But after hitting those 2021 highs, silver consolidated in the $20 to $30 range through 2022-24, with individual bouts of volatility, e.g. COMEX inventories dropping, Indian demand jumps at Diwali, or Fed rate hike worries. By late 2025, it had climbed back to near $30 again. Many thought the drama was over, but they were wrong. Each of these historical swings rattled global markets beyond just silver dealers. The 1980 crash put strain on banks and redefined commodity trading rules. The 2011 surge fed into talk of systemic risk. Some said it presaged wider bubbles bursting. After each surge, regulators blinked, saying they'd watch markets to avoid manipulation. The world also saw something important: silver's wild nature. It can be quiet for years, then explode and implode, affecting mines, tech industries, and even national economies that depend on it for coinage or electronics. Rhetorical pause: does 2026 look like 1980 all over again? Some parallels are striking. Leverage-driven rallies, margin hikes, supply crunch fears. But new actors have emerged and new rules apply. Today's market is globalized and digitized. The financial system has grown far larger, with trillions in derivatives trading, and China is now a silver titan. If the past is prologue, we might expect another crash, or we might be looking at a fundamentally different story. One thing's for sure: history shows silver doesn't whisper. When it speaks, the world listens, or it gets burned. 3. The tale of two prices: paper versus physical silver. Why did silver in January 2026 shoot to different prices around the globe? The answer lies in the split personality of silver pricing. The paper market price and the physical market price. These two have diverged dramatically, and that divergence is at the heart of the current frenzy. Paper silver, futures, and ETFs. On most stock exchange screens, silver is quoted as a futures contract, e.g. COMEX, or an ETF, like SLV. This paper price is what traders see on Bloomberg terminals. It represents a contract for delivery in the future, often settled in cash rather than metal. Paper silver is leveraged. You can control much more silver than you actually pay for by posting a fraction of the value as margin. It's mostly dominated by big banks, hedge funds, and speculators. Manipulation here is easier. Institutions can buy and sell huge contracts with little actual metal movement. Physical silver, bullion, and coins. In contrast, the physical price is what you actually pay to hold a real silver bar or coin. If you walk into a bullion dealer, your cost includes the base metal price plus a premium, minting, shipping, dealer markup. Physical silver is finite. It must be mined, refined, transported, and stored. Demand is tangible. Industrial factories use it, jewelers craft it, and savers hoard it. In normal times, the physical premium is small, a few percent. But when supply is tight or demand spikes, premiums can surge. In January 2026, these two diverged spectacularly. Here's how to think about it. Imagine the COMEX future price as a number on a screen. Before this rally, COMEX was quoting silver at, say, $72, $75. That was the official price. But actually buying metal was a nightmare. In markets like Shanghai, Hong Kong, Tokyo, and even Mumbai, dealers simply didn't have much silver to sell. When they did, they charged top dollar. Premiums shot through the roof. We heard of anywhere from 8 to 15 per ounce premiums in China and the Middle East. If COMEX said $75 physically, people in Asia were willingly paying $83, or $85, even touching $90+ for immediate delivery. This created an arbitrage pressure. Why should paper and physical differ so much? In theory, if a smart trader could buy all the COMEX silver at $75 and then truck it to Shanghai to sell at $91, they'd make an $16 profit per ounce. But in practice, it wasn't so easy. China's new export license barrier meant silver couldn't flow out legally, and U.S. regulators were eyeing surprise taxes on silver, so the gap stayed wide. Paper traders pretended all was well at $75, even as actual metal was commanding much higher. What causes such a gap? Two main factors. 1. Speculative constraints. When COMEX traders see silver soaring, the exchange often makes it harder for them to buy more via margin hikes to prevent a runaway bubble. This can artificially cap the paper price. Meanwhile, 2. Physical demand explosion. If thousands of investors are actually buying real silver bars and coins to stack under their mattresses, shops run out, and any supply that remains drives up the physical price. The paper market ignores this until the gap is too big to hide. The current situation feels like a classic short squeeze scenario, but on a global scale. For years, big banks may have held enormous short positions in futures, betting silver prices would stay low. If those banks now face a reality where delivering silver at $75 instead of $90 is a huge loss, panic sets in. Margin calls, forced rollovers, and leverage liquidation can scramble the paper price. The goal for these big players is to keep the futures price under control so they don't lose even more on their shorts. Hence the margin spikes on deck 12, 29, 31. It's as if the stock market traded 100 for one split without warning. In plain terms, if you are not deep into finance lingo, think of paper silver as monopoly money and physical silver as real cash. When everyone believes the monopoly money is worth $75 per share, but in the real shops the price is $90, you know something's up. And if big banks own all the monopoly money contracts, futures, and have to face an 18-Oz shortfall on each contract, they get very nervous. Are you going to trust the monopoly money quote or the real-world price printed on a silver bar? This gap is becoming unignorable. An 80% premium on physical overspot is unheard of, except maybe in a true liquidity crisis. For viewers, imagine a world where everyone is trying to buy water, but the official market price for water bottles is low because distributors have a different plan, while actual drinkers pay triple at stores because bottles sold out. That's the current silver paradox. Rhetorical jab. So who really owns the silver? If paper owners are sitting on contracts, but physical owners are clinging to real bars, which price tells the truth? We'd wager the latter. After all, you can't eat a contract in a power plant. 4. Puppet masters. In the metal market, the great silver conspiracy. Whenever silver stages a circus, whispers of manipulation follow closely. This time is no different. Who's pulling the strings of this silver theater? Many eyes point to the usual suspects, the largest bullion banks and Wall Street institutions. Let AS lay out the conspiratorial narrative, the story of how big players might have been managing silver's price for years and why they now seem on the back foot. Banks and exchanges at the helm. The major bullion banks, think JP Morgan, Goldman Sachs, HSBC, UBS, etc., have historically been big players in metals. They are market makers and also trade for their own accounts. These banks have access to almost unlimited capital and sophisticated trading desks. The theory goes like this. Over the past decade, they've sold more silver on futures than they actually hold in any vault, i.e., they've been net short. The advantage of being short is you profit if prices stay flat or fall. With paper futures, you can sell contracts at $20, $30, $50 for delivery tomorrow or next year without needing the physical metal now. In the 2010s and early 2020s, silver wasn't rising strongly, so being short was safe. If prices stayed tame, these banks collected premiums or borrowed silver cheaply and pocketed the difference. How would manipulation fit? If a bank has 5,900 tons of short exposure, a figure rumored in market circles, for example, the incentive is enormous to prevent a price spike. The allegation is that such banks would quietly use various levers to keep silver S paper price suppressed, ever tightening margins. As we saw, the CME group, operated by big banks, raised margins multiple times in short order. Officially, this was to calm volatility. Conspirators say it was more to dissuade aggressive buying. Every margin hike forces small traders out. They can't afford the bigger deposit, leaving only the deepest pocket players. Bear raids and short sells. In an ideal conspiracy world, banks would flood the market with new short contracts whenever silver ticked up, overwhelming buying interest. We saw rumors of spoofing prosecutions. Years ago, 2 JP Morgan traders were convicted of attempting to manipulate gold and silver prices by placing large fake orders. That is proof such tactics have occurred. Media misdirection. Financial media and analysts sometimes warned about a silver bubble, urging caution. If many people believe silver is a speculative froth, they might hesitate to buy. Recall the old saying, headlines follow the market, but coordinated messaging can still nudge sentiment. Some conspiracists point out how pundits suddenly fear volatility after every spike, as if to justify the margin hikes. Creating fake supply. Another tactic is leasing silver or using loans to pretend more inventory exists. LBMA rates, fees to borrow bullion, going to record highs in late 2025, hinted that actual available silver was vanishing, yet paper volume stayed high. It's like a magician. Wave the wand, phone trade moves, and say, ta-da, more silver here. For decades, such moves may have kept the lid on silver. Each time silver threatened to break out, like in 2011, the authorities, exchanges, and regulators, mostly under influence of these banks, intervened with tools, higher margin, trading halts, rule changes. Often, this just meant the paper price was controlled while the hidden physical deficit grew. Silver's admirers have long complained about this dual reality. COMEX says $25, but coin shops charge $27, a small gap. Now the gap is enormous. Is the system unraveling? The drama right now suggests the bank's control might be slipping. Physical metal is in such high demand that even massive margin hikes and sales are quelling the fever. Rumor surfaced, take with salt, that some big banks scrambled for cash in late December. Some even claim an unnamed U.S. bank got a secret $17 billion lifeline from the Fed on Deck 26, allegedly to cover losses tied to silver trades. If true, this would be headline-grabbing proof of pressure. Even the central bank had to step in when things got out of hand. We emphasize rumors because nothing official is proven, but these stories spread like wildfire on the web. Consider, if a giant bank had to deliver actual ounces to settle a futures position and found there wasn't enough silver in its vaults, that bank would be in a mathematical trap. One futures documentary called it the undeniable evidence that the COMEX silver market is facing a physical default. Whether you buy that or not, the key point is this. The very existence of such tales shows how suspicious minds are. When skeptics talk about banks papering over silver shortages, they point to events like these: repeated margin hikes, shrinking COMEX warehouse stocks, and Western vaults running low, since Asia is hoarding most new metal. To outsiders, it's like watching a stacked deck being played. The banker always seems to win, until the game suddenly changes. One thing is clear: the banks prefer a calm, low-price environment. But China's aggression, and now India's interest, may have sidestepped those walls. As one conspiracy-minded voice put it, either the paper price is fake, or there's no actual silver backing those contracts. Many suspect it's both. Question to audience: when the puppet masters always pull the strings, can the marionette ever break free? Are we witnessing just another carefully orchestrated sell-off, or the beginning of the end for the manipulators' grip on silver? 5. East versus West, a geopolitical silver showdown. Silver's 2026 story isn't just about traders and banks, it's geopolitics as well. The stage spans from Wall Street to Shanghai to Mumbai. Different players see silver through different lenses. China, the new silver behemoth. In the past decade, China has emerged as a titan in both consuming and producing silver. It mines a lot of silver domestically and also refines imported metal. Its industries, solar panels, electronics, EVs, chew through huge quantities of silver. By late 2025, China was shipping out over 4,000 tons a year, with only 220 tons imported. Suddenly, Beijing slapped on export controls. Why? On one hand, to secure silver for itself, the government has declared silver a strategic resource needed for high-tech industries. On the other, to gain pricing power. By restricting exports, China can influence the global price. This move immediately tightened the market outside China by up to 60-70% of supply. It's as if OPEC suddenly cut oil exports but still sold fuel to itself. The result was immediate. Shanghai's local price soared. Traders on the Shanghai Futures Exchange, SHFE, and at the SGE now set prices for physical silver delivery in yuan. Those prices shot way above the Western charts. State media framed it as patriotism for industry, but others saw it as a power play. Meanwhile, Chinese retail investors were snapping up silver aggressively. Social media buzz on Weibo, Xiaohongshu, etc. showed posts about arbitraging China as pure silver fund, the UBS SDIC silver fund, by buying its shares even though they traded at a huge premium to net asset value. The frenzy in China resembled a consumer gold rush. Everybody's buying silver. The United States, regulator, and consumer. In the US, silver is less revered than gold among general public, but it's strategically important. The US uses silver in defense, space, and tech. Ironically, America imports about 64% of the silver it uses. That's a vulnerability. In late 2025, insiders report the Commerce Department began reviewing silver imports for national security, a process similar to rare earth investigations. Any tariff or ban on silver imports would further squeeze markets. On the trading side, the Fed and exchanges in NYC tried to dampen the surge by raising costs for speculators. Politically, silver's been a topic. Congress sometimes floats ideas to replenish silver reserves, like that old Strategic Silver Act, or even mint inexpensive coins for investment. But action is lagging. American retail investors had mixed feelings. Some who saw silver at $30 were thrilled to see new highs, others panicked.